just around 3% of global GDP. So when you have, so on balance, you can see that things are going very well, concentrated in few countries, but those countries are really the engine of growth and for the global economy. And hopefully that will be spilled over to other places as well. And I hope that India will get its infection rate under control very soon. But after that, also the Federal Reserve, they maintain their policy. I was not expecting any surprise. And Powell, the chairman, keeps on referring to something that he's been saying for the last few months. And he said that this is, yes, we are seeing a recovery. Things are looking better, much better than before, but he warned it's still a rebound, not a recovery. And he said that they are not yet at the level of unemployment that where they would like it to see going, so that would trigger any changes in their policies. So on balance, things seem to be heading in the right direction for the global economy, for oil markets. But of course, risks abound. So you can continuously see the word risk and uncertainty, and they're synonymous in various outlook. But I think, the train has already left the station. We're heading in the right direction. Hopefully, in the developing world, in India in particular, things are going to look better once they go through this terrible phase they are facing today.
Victor Yang, senior editor at JLC Network Technology, sitting in China. Victor, it would seem that the Chinese have been drawing down a lot of inventory in recent months, having bought a lot of cheap oil last year. Can we expect that trend to sort of ease off now and for China to come back into buying mode?
Yes, well, and when we talk about imports, March imports were quite high, and April imports are expected to drop a little bit, maybe to about 45 million metric tons, were slightly down from 49 million metric tons in March. And on a year-on-year comparison, the imports in the second quarter may not grow because last May's imports were surged to a record high. And this year we are seeing more maintenance in the second quarter. But apart from that, economy grows fast and domestic consumption is growing fast. So this is also kind of booming demand. And we had another major refinery coming online later this year. So things seems quite good, yes, in the near term, yes.
The situation, let's bring in our new guest speaker, Maliha Mbegali, founder of MB Commodity Corner. Maliha, the sort of fundamentals of inventory we saw in the US yesterday, inventories climb a little bit on the EIA report. Earlier in the week, the API had indicated a much bigger increase in US inventories. But nonetheless, global inventories are decreasing week on week, and we're getting very quickly near to that 5-year average that is the big target for OPEC plus.
In terms of inventories, I think you're absolutely right. OPEC has done a very good job in containing the market and supporting right here. The inventories, what I looked at was gasoline and distillate. As we spoke last week, is the distillate demand week on week has been picking up. And that's key to where the market goes in the summertime and the summer gasoline season, right? So gasoline demand is holding really strongly due to mobility in the US and other places. So if we see a pickup in gasoline demand and travel demand once the lockdowns reopen, I think that could be supportive. So the eye is more on the product markets and the oil markets. The oil price is actually plateauing here because, as Dr. Carroll said, the India coronavirus cases is damping demand, but US and European demand reopening is going to provide support to the market. So June is going to be a very important time for the market, but the inventories are going the right direction right now, for sure.
In terms of India, Maliha, so far the government has resisted moving to a total national lockdown. We do have a case where there are state lockdowns of different sizes. We've got, for example, Delhi is in lockdown till May 3rd. The Maharashtra, with 123 million residents, has serious curtailments till May 15th. What are your own thoughts? Will the Indian government resist a total lockdown, or could this situation force one upon them?
I think they will do whatever they can to resist a national lockdown. In my humble opinion, I think they will have no choice but to make it a lot more harsher because they have to get the numbers down. This is going to be a humanitarian crisis. I mean, I think some of the numbers are probably more than the press is reporting. Having said that, we are probably 2 or 3
I
months.
was listening to a New York Times report this morning that said from their sources, that from the New Delhi New York Times correspondent, he said the actual numbers are 10 times what are being officially reported. So 3,000 deaths is 30,000 deaths, 300,000 infection is 3 million infections. This is a very large challenge.
It is a large challenge, but if you need to put these numbers in context, from a humanitarian point of view, you're absolutely right. India is going through a crisis right now. So we've discounted 3 months in terms of mobility data for India. But having said that, how much does that really equate to oil demand? We're talking about 1.5 to 2 million barrels per day. So that could have an impact on the oil inventory markets. But if you sort of offset Europe picking up and US picking up, that is why the oil prices are pretty much range bound right now. So you need to take a step back, because as OPEC has reaffirmed their commitment to increase production in May by 350,000 barrels per day through July, there is no shortage of oil. I keep saying this to people, it's a timing game. So you get these influencing factors where the slowdown causes inventories to build in some regions, but then you have the demand pickup, which tends to be positive. And because companies like Goldman Sachs have this $80 per barrel higher oil price forecast because they assume everything will be working on all cylinders. And that's true. If we get demand resurgence, global economies picking up and summer demand picks up, sure, oil pricing can go up, but we have all these offsetting factors that it's very hard to gauge right now until you see what Asian demand is doing, how the summer demand is doing, and also how the economies are opening up though. And the oil price is time to take a decision.
Yeah, one of the unknowns, which I think is still a little bit, impossible to calculate, but India is the largest producer of vaccines, particularly AstraZeneca. If this crisis was to continue to escalate, the outlook for vaccines could become could get caught in that dynamic. At the end of the day, less than 10% of the Indian population is vaccinated, and yet they're exporting millions of vaccines every day. I'm not sure that's a sustainable equation, but we're not equipped here really to get into that. Carol, we saw yesterday the Federal Reserve Chairman again project a very strong commitment to the easing policy that they've maintained for some time, despite soaring prices across the commodity project. The result of which is the dollar weakness continues now to be bedded in, and the outlook continues for a weak dollar to be bedded in through the year, maybe even getting weaker. I'm wondering, from your point of view, how does that impact the overarching macro outlook?
Yeah, sure. I mean, for the US, things are heading in really in the right direction in terms of recovery. But for a while, the Fed has been telling us to expect what's happening today. So a bit of pressure on prices, perhaps it will translate also in weaker dollar. But it's not yet where they want to see the economy going. And that's how we see also Biden continuing to announce one package to support the economy, another package now to support families, another package previously too for the investment. So a lot is happening in the US, and we see the spending power of people is picking up accordingly. So I wouldn't expect a drastic change in market conditions in the US in macro outlook. The Fed is keeping a close eye, but somehow they managed to appease fears, at least for now, of inflation, though that is likely to reemerge if things continue to heat up. So it's not just a temporary increase in prices, but become more sustainable. Then we might see the Federal Reserve revisiting its policy. But Sean, I want to go back to this question about the inventories, because I know now we take it for granted when we compare to the 5 years average. But one thing that always comes to mind is that this 5 years average is rather misleading, because it contains the period between 2015 to 2017 of also record, maybe not as much as high as 2020, but a record build-up of inventories then. So I wonder, when we talk about the going back to the 5 years average, whether this is the right indicator, and add on top of that the spare capacity of OPEC, or OPEC plus, if you want to include other countries as well. So while at the moment, this is in line with what I said about the US economy, it's a more metaphor to apply on oil markets, that while things are looking rosier compared to where we were previously, I think the challenges will start to emerge from the second half of this year or towards the end of this year, where we're going to see the pressures that put perhaps a lid on oil prices becoming more pronounced. So while we're heading in this recovery phase, so it's all relative what we're discussing here compared to what, I think the challenges will be more pronounced, although are going to be a little bit different from the second half of the year going onwards.
Victor, we had this week the Chinese government announce the what they call the energy work guidance for 2021 that was put out by the National Energy Administration. The essence of it, I mean, it involved a lot of details, but one, ultimately, China is set to cap coal consumption in 2021 to less than 56%, which will allow, at least in terms of the strategy, for domestic oil and gas output to grow. Is that a viable policy to cap coal consumption? Is there the resources there for oil and gas to fill the gap?
Yes, well, I think it's a viable strategy. Well, and actually, China has been cutting the consumption of coal in the energy consumption over the past years. So it has been doing so, and to achieve its targets for the emission reduction, it has to reduce the consumption of coal, and it can replace this with oil, gas, and hydrogen and some other energy. And it's now also promoting, it has a lot of policy to encourage the development of hydrogen too. And say, Sinopec plans to build 5,000 petrol stations fueling hydrogen in the coming 5 years. And PetroChina has also made the plan for its hydrogen development. So the country is actually, developing all kinds of possible alternative energy to replace coal and sometimes, even oil too. So I believe we can do that, yes,
Malia, the Goldman Sachs forecast we have in our news digest today, they're calling on $80 oil in the summer months, prices to rise with the growth of this sort of long expected demand recovery of 5 million barrels a day to come sort of like a tsunami wave come, I don't know, July 4th and suddenly bang. But nonetheless, Goldman Sachs calling a big dollar number over the summer. I wonder your thoughts about it. Is it realistic?
I think it's realistic if you think everything sort of lines up correctly. Like I mentioned, if Europe opens up, gets the vaccinations in order, US has a great demand season on the summer driving. We're already seeing vehicle miles picking up. And obviously we have Asian demand coming in. So if you get all of that, June to August and September typically is a very strong demand period. Like we saw in Q1, despite OPEC keeping oil, there was being a lot of oil, we saw higher prices. So we can get lucky and get oil prices higher. Absolutely. The other thing that's very important, alluding to the Fed policy, the Fed is keeping monetary accommodation very loose. We saw the comments last night. They're not happy with the inflation numbers. They think this is just transitory. And I think that's very important because it means their foot is on the gas and they're going to be pumping a lot more liquidity. That means more inflows into inflation stocks. Now, this is something that can take the energy markets higher. This is outside of physical market fundamentals. As you see more and more inflows coming in, which is also Goldman's thesis, we can surely see oil prices higher once we get all the right summer conditions. So I think the next 3 months or 4 months can be very positive if we get the demand pickup. But I agree with Dr. Carroll, towards the second half of next year, there is no shortage of oil. We have a low spare capacity and there are some clear concerns on demand going forward. So it is a timing game, but I think commodity inflows coupled with very sort of easy liquidity is also it's quite possible to see that number. It depends on the demand.
What is the outlook for the impact on oil markets for that inevitable day? It's not a matter of when, but if the Fed turns the corner and signals a tightening trend rather than this sort of historic easing?
Oh, so we are waiting for the day they announce some sort of a taper. They are hiding behind a muted CPI number of 2.5%. We know inflation is much higher in all the prices. And they know they have some time right now, but if we get CPI prints of 3.5 to 4%, they will need to taper. If that happens, oil pricing will fall $10 per barrel easily. Along equity markets, this entire market, every single asset class, is fueled by liquidity, the equity market, technology stocks, gold, silver, whatever have you, everything will fall. So yes, and the fact that oil market is not a tight market like copper, it will fall a lot more, so, as with everything else.
Carol, as you mentioned earlier, the announcement by Joe Biden, president, on yet further stimulus packages. He's got $2 trillion plus infrastructure package currently under negotiation in the Congress. He announced in his speech last night yet another one regarding education and all sorts of other goodies. Do you think, what is the outlook for stimulus fatigue, if you like? We have Larry Summers, the former Treasury Secretary, has been signaling for some months now that this stimulus is risky and that there will be a point of fatigue. Is there still a need for it to the scale that he is advocating?
Actually, I see the last package that Joe Biden is trying to push for the American Family Plan targets more the issue of income disparities within the country. So I wouldn't see it as the conventional fiscal stimulus package. And that is very important, especially today, because, and again, it's something that the IMF warned a lot about in their latest outlook in April. And they said that income disparities, although it was pretty pronounced before COVID, whether between countries or within countries, are becoming more of a problem after COVID. And in the US, this has been a problem because the rich got richer and the poor got poorer. And I think what Biden is doing is trying to reduce this gap by tackling, imposing high taxes on the high income earners and trying to support the poorer families or the less wealthy people. So in this respect, I think his latest package makes sense to me because he's trying to address a problem that can cause lots of problems in the future fundamentally. And even on a global scale, I see Andy in his comments here in the chat box talking about uneven recovery. Absolutely. But for me, that does not necessarily translate into, for example, holding back global economic growth. What is more worrying for me is growing income disparities, because that can lead into many problems, whether in terms of social unrest, in terms of poverty, exacerbation of poverty in already poor countries, such as the poorer countries in the developing world. Even it has implications on the energy transition, because you cannot have energy transition with expensive or with the income disparities and expensive prices. So all in all, that is a problem that Biden is trying to tackle today within the US, but it also has to be considered in a broader picture. So it's not quite like the conventional fiscal stimulus that he pushed for at the beginning of the year.
Victor, we've had news this week also out of China of the beginning of a sort of domestic consumption campaign, the Chinese government encouraging buy Chinese, I suppose, ultimately. What is the outlook for that? Is that like a kind of a Singles Day? Could that be a stimulus to the local economy? What is your outlook for that?
Well, say from May 1st on, we are going to have a 5-day holiday. And this actually is just 1 day off, but the government made it 5 days by having 2 more, working days on the weekend. And then together with the weekend, 5 days, especially with just 1 day off. This is also one of the measures for the government to stimulate consumption, to make holidays longer. And it has been rolling out some kind of similar measures, because of the dual circulation strategy. But say it is relying more and more on domestic consumption to stimulate economy growth. So over the long term, it's necessary because the country cannot rely all that heavily on foreign trade for domestic growth. And particularly at such a turmoil, era, the pandemic. And even over the long term, it would be necessary, yes, but there would be kind of way out for sustainable development in the future, yes.
Maliha, we had obviously the OPEC meeting this week, a bit of a non-event, but nonetheless they did roll over, but they did also continue to hold on to their forecast of 6 million barrel a day demand recovery. Would welcome your views on that decision, and also the news overnight that the US stands ready to roll back nearly all Iran sanctions. That's according to the Associated Press, usually pretty well-sourced news agency when it comes to American news. So Iran could be coming back into this OPEC plus equation even more than they are unofficially.
Absolutely. So that's another sort of potential bearish factor on Iran. That's worth about 2.5 million barrels a day, effectively. I think OPEC did the right thing to wait another month because it's too early for them to gauge before summer demand picks up. I think by the end of May, they will take a decision to either roll over the cuts or keep them off the market. It all depends on India and how the US summer driving season starts. So the right thing to do was to hold off and sort of extend the agreement. There is a factor that they might just keep these barrels off the market all throughout the summer if the demand doesn't pick up. If that happens, obviously prices can go higher, but they're taking 1 month at a time because they want to make sure that all the hard work they've done is supported. But then again, it's a very near-term game because like there is a high spare capacity of oil. And right now, like you said, Iran's coming back on again if the deal goes through. US shale is also debatable. How much oil starts coming back on back of the US rig counts picking up? People seem to be torn about as to how much oil can come from there.
Carol, there does seem to be a kind of a, if you're speaking of the endless metaphor, glass half full, glass half empty, it does feel like Europe has turned the corner a little bit. You're sitting in the heart of it there in the German Black Forest. Does it feel from the ground that Europe has turned? We've got all sorts of talk now about opening up for the summer holidays. Greece has already taken the first step. Spain has announced plans for welcoming tourists, etc. What's the view from the ground?
Definitely things are improving here in terms of the speed of the vaccination rollout after the massive, the shocking, I would say, poor coordination at the beginning, where we were praising Germany for being an example for how you get things, a crisis under control, and then they became a laggard. So things are improving, and that's another positive factor to add to the market outlook and global economic outlook, because don't forget the EU is the largest economic bloc in the world. Now, what that means later on to tourism, we're not quite sure. So maybe the summer season, this is here where you're hearing more doubts about the summer travel season. And it's not that's not going to happen, but it seems to be pushed more for the autumn. So instead of taking holidays in the summer, because people are still concerned about restrictions, about the PCR test that they have to take before and after, and that increases the cost of traveling. So you may take an EasyJet flight, which costs nothing, but then you compound it a lot by the test that you have to pay for. So if we look at the travel agency, the conventional ones, they tell you that there is more pickup in the autumn booking international holidays, at least within the bloc, within the EU, rather than the summer. So it's a question of timing, but definitely things are improving in the EU, though we are still waiting for our turn to get vaccinated here in Germany. And it seems to be we are at the very bottom of a long list.
Well, you're a fine young,
at least,
you're a fine
right?
young, healthy woman. There it goes. Let's get the survey question of today and get the room to have a view. US GDP are to report due later today, where market forecasts are for annualized growth of a whopping 6.1%. Has oil markets already baked 2021 growth into the price? We've had these forecasts with the IMF, the World Bank. We've all heard about 6.5% on the US economy. Now the first quarter GDP results are to come in today. My question is, has the oil markets already baked this into the price where we're sitting mid-60s on Brent, or is that growth still to come, as the Goldman Sachs are forecasting $80 in the summer? Has it already baked this into the cake? That's the view. That's the question. Maliha, your thoughts on that and the outlook for, there's so much expectation built into all financial asset classes that this whopping second half of the year is coming. I'm wondering on all commodities if indeed their prices are baked that in, or there's more upside to come.
I think the market's very well ahead of the curve in terms of how much growth is priced in across the board, whether it's copper or what oil or what have you. I think what concerns me the most is Chinese credit growth. And Victor can probably give us some color on that, is that we've seen a slowdown in Chinese credit growth since November last year. So they are sort of stepping back a bit. We've seen the negative credit impulse, which means that that's leading to a lower demand net versus last year. In the first half, you have higher demand from the US and developed markets. So my concern in the second half is what happens if Asian demand is lower and US starts tapering. So my concern is that the positivity of first half is more than priced in. My concerns are paramount on back of dollar tapering and QE stepping back, the Fed stepping back. So I would not see those higher prints as being a marginal positive. In fact, I think it's more than priced in a host of commodities. It's
Victor, just on that point, credit tightness in the Chinese economy. I know that their government has been a little bit concerned about that.
Well, actually, it's not that tight, we might say. Perhaps it's not as low as at the beginning of the, well, say the last year, when the government was pushing forward with the recovery, manufacturing recovery, production recovery, and so on. But it's still relatively loose. Well, it's maybe slightly a little bit from last year, but it's still actually encouraging investments. And we'll say even in the real estate industry, say a few years ago, the government made it clear that, well, banks shouldn't lend money to the real estate markets. Well, restrict this very tightly because, well, the government didn't want to rely on the real estate industry for economic growth anymore. But since last year, the government allowed banks to lend money to the real estate company again. Loosen the restriction, and now allow the infrastructure construction. Well, it's booming, including the housing construction. But this was kind of against previous policies. We'll say, well, for a period of time, the government didn't, discourage, well, the fast development of housing industry, because the housing price is way too high, and it's this kind of bubble. So the government is trying to avoid that. But now, say since last year, to stimulate consumption, and the industry had kind of roll back to the old policy. So it's now kind of cutting down on this kind of support to the real estate industry. And I think that's good. It should be doing so. Otherwise, we will be going back to the previous years, well, say, depending on the real estate markets for development, and the housing price still keep rolling. That's no good for the country's economy over the long term.
That seems to be an issue globally now, with property being the sort of new Bitcoin in some regards. Let's get the survey result and give Dr. Carroll the last word today. Has oil markets already baked 2021 growth into the price? 64% saying yes, at least that's the view in this room. Carroll, your thoughts on that, and also welcome your comments on the latest story overnight, also in our digest, about possible Chinese investors buying 1% of Aramco. We also have OQ, the Oman National Energy Company, announcing that they're going to be selling off assets. We had recent reports a week or two ago that Aramco is selling off some of its pipeline business and so forth. The national energy companies raising capital through selling assets. It's becoming a bit of a trend.
Indeed, in the region, it is becoming of a trend. But in Saudi Arabia, don't forget, it was part of their 2016 Vision 2030 for Saudi Arabia to sell. Originally, they were talking about 5% sale of Aramco's share, but then they end up doing it 2% and only for domestic investors. Now they are going more towards international market and selling to the Chinese. At the beginning, people were guessing, but when I heard the Crown Prince interview, he added one sentence without naming, without specifying Chinese. We're still guessing. But he said it's a company, a major company that comes from a very important country, especially for our oil. I mean, that's my poor translation. But that made me immediately think of China, because China, if I'm not mistaken, is the biggest buyer of Saudi oil. And it makes sense, economically speaking, because you have the seller and who wants to lock in the demand for as long as possible in a more competitive market in the future, and the buyer that is China, and China is going to drive along India the growth for oil demand in the future, coming together to in an agreement, direct agreement. So it makes sense. But as you said, it's also a drive in the region, whether in Oman or in the UAE, partly to diversify a little bit their economies, but also to raise revenues. But again, this can happen. This is not going to happen overnight. Saudi Arabia, we're talking, I mean, the Crown Prince said it's not going to happen before a year or so. But this is part of a general trend that is happening in the region, partly to diversify, raise money, but also secure their market for the future.
Yeah, a lot of politics in that, I'd say, selling 1% of Aramco to the Chinese. I think that would have to be a phone call or two to Washington, I would suspect. Let's see how that plays out. So that's a wrap for the week. I'll just take note of commentary as we've done in the chat room. Our regular Monday commentator, Omar Najia, who's once again letting people know that the price from his forecast, from his calculations, WTI took out 64.38 yesterday, and that's a technical sort of resistance, and now he sees his sights set on 68 and towards 73. Omar has called the market quite accurately a number of times over the last year, so maybe wise to at least review some of his comments there. But thank you so much, Dr. Carol from Germany. Looks like the sun's shining. You're able to go outside and enjoy the beautiful spring weather. We're very jealous as we retreat indoors now with the oven of 40 degrees. Maliha, thank you so much for joining us. We'd love to have you back. Victor, nice to have you from China. Thank you. And to everybody else, have a great weekend, and we'll catch you up next week. We'll have Christoph Ruhl and Mike Muller sort of doing the market review on Sunday. Please join us. All the best. Thank you.
Thank
Thank
you.
you.
Bye.
Have a good day.